Make no mistake, the rise that we're seeing in commodity prices, and it's quite broadly based, is good news for the Canadian economy and good news for Canadian investors. Of course, a substantial chunk of our equity market is tied up in resources, whether that's energy or mining or forest products. And those companies are certainly showing a big lift in profitability at these higher prices. And for the Canadian economy, that does mean more jobs in some of those sectors, but importantly, it also means more money to go around in the economy among the workers, shareholders, and other participants, including governments that levy taxes on companies in these sectors. So in the here and now, this is definitely a gift for the Canadian economy and a gift for Canadian financial markets. But historically, it's worth noting that these sorts of commodity rallies rarely last that long. There was one so-called commodity super cycle that was associated with China's big industrialization wave, in which that huge economy sucked in so much raw materials that they elevated prices for several years. But in most of the other cases that we've seen in decades past, commodity prices have rallied for a year or two and then essentially given back much of what they've gained as supply starts to catch up. If you actually take commodity prices today, for example, and deflate them by the CPI. So where are they in terms of real prices relative to decades ago? Actually no higher now than they were in 2001. So technology improvements in mining, in extraction industries tend to offset the increasing scarcity of those resources and keep their prices in real terms roughly constant over the decades. So enjoy it while it lasts in terms of returns in your portfolio in resource-oriented stocks, but don't count on that lasting forever. One of the potential negatives of stronger commodity prices for the Canadian economy is that with them, we tend to see an elevated level of the Canadian dollar. And while that's something that the commodities exporters can certainly live with because they're getting higher US dollar prices for their goods, we have to remember that Canada is more than a resource producer. In fact, only a minority of Canada's exports are raw materials. We have a substantial export basket in everything from automotive equipment to aircraft to machinery to pharmaceuticals. And for those companies, a higher Canadian dollar means that you're paying your workers more in US dollar terms, and therefore it becomes tougher to compete in some of those foreign markets. So we're actually hopeful that the Bank of Canada sends at least somewhat of a message to financial markets in terms of providing a bit of resistance to an ever stronger Canadian dollar, perhaps reminding investors that the stronger the Canadian dollar gets, the more there's a drag on Canada's export sector, and the more that could delay interest rate hikes from the Bank of Canada. Even if we don't ultimately see that delay in rate hikes, just the expectation of that should help the Canadian dollar level off at some point here. Ultimately, we get into 2022, we think that the global economy's production engines will be better in gear. We won't have the same restraints we have on production of many of these raw materials, the same shipping delays we're seeing. And so in many cases, even though the global economy will actually be stronger in 2022, we might actually see some of these resource prices a bit softer. And therefore, we're also expecting the Canadian dollar to be a bit softer when we look into 2022 than we might see in the here and now. So the message for investors is, yes, capitalize on the good days for commodities while they're here this year, but don't tilt too much of your investment basket to those quick wins in resource markets. Maintain a kind of diversified portfolio that will benefit from a broader economic recovery that we expect to see over the next year and a half.